Hey everyone, welcome back to Corporate Decoder, the place where we take those confusing corporate reports and make them make sense. And let me tell you, this report, it's a roller coaster of zero revenue, loans from the CEO, and maybe, just maybe, buying a scrap metal company. So buckle up. Today we are diving into the latest quarterly report from First America Resources, and spoiler alert, it's a wild ride through financial quicksand. So let's dive right in and try to understand what on earth is going on. First things first, this is a Form 10Q, which means it's a quarterly report. It covers the period that ended December 31st, 2024. So this is pretty up to date. This report shows how First America Resources did in the last 3 months of 2024, and for the 6 months of 2024, the first half of their fiscal year. The company we are talking about is First America Resources Corporation. They're based in Nevada, but their main office is in Illinois. Here's an important checkmark. The company says they filed all the required reports on time. That's good. It means they are trying to follow the rules, at least on paper. Now this is interesting. They check the box saying they're a shell company. A shell company basically means they don't have any real business operations. They exist, but they're mostly empty. That is not an amazing start. As of February 19th, 2025, they had about 8 million shares of common stock outstanding. This number will be important later when we look at how much each share might be worth. Alright, let's get into the numbers. We will start with the financial statements, which is essentially their report card. First up, the balance sheet. It's a snapshot of what the company owns and what it owes. They have about $25,000 in cash, not a huge amount for a public company. They don't have any prepaid expenses, meaning they haven't paid for any services in advance. Adding it all up, their total current assets, which are things they can easily turn into cash, are also around $25,000. Total assets, well, it's the same number, $25,000. That means they don't really have anything else of value besides that cash. Not good at all. On the liability side, which is what they owe, they have a few $1,000s in accounts payable. These are bills they need to pay soon. Here's a big number. They owe over $228,000 to their officers, basically. Money the CEO loaned to the company. This is a big red flag because it means the company is heavily reliant on its CEO to stay afloat. When you add it all up, their total current liabilities, which are debts they need to pay soon, are over $232,000. Their total liabilities are the same, $232,000. They don't seem to have any other debts. They have a little under $8,000 in common stock value, which is the stated value of the shares they've issued. They have about $291,000 in additional paid-in capital, which is money investors paid above the stated value of the stock. But here's another problem. They have an accumulated deficit, meaning they've lost more money than they've made, of over $500,000. This means their total stockholders' equity, what would be left over if they sold everything and paid off their debts, is actually a negative number, negative $207,000. This means they are technically bankrupt. The balance sheet balances like it should, but that does not make the numbers look any better. Next, the statement of operations, or also known as the income statement. This shows how much money they made or lost over a period of time. For the 3 months that ended December 31st, 2024, their revenue was zero. Yes, zero. They didn't make any money at all in the last 3 months of the year, and for the 3 months of 2023. And for the 6 months that ended December 31st, 2024, again zero. But for 2023, they made a bit almost $4,000. Of course, if you sell nothing, you have no cost of goods sold. Nice. This is what it cost them to sell. Their gross profit, which is revenue minus the cost of goods sold, was of course zero this past semester. They still had to pay for things like general expenses to keep the lights on. For the quarter, this was about $34,000, and for the 6 months, it was about $35,000, so it's mostly fixed costs. Their total operating expenses are the same as their selling, general, and administrative expenses because that is all they are paying for. This all leads to an operating loss because they didn't sell anything of $33,000 for the quarter and $35,000 for the semester. Their loss before income taxes is the same as their operating loss. And finally, their net loss, which is the bottom line, is a loss of $33,000 and $35,000 for the quarter and semester, respectively. Their loss per share is basically zero because they have so many shares outstanding. As a reminder, they have almost 8 million shares outstanding, which makes per share numbers very small. Now let's talk about their statement of changes in stockholders' deficit. I know it sounds like a mouthful, but stick with me. This statement shows how the company's ownership structure has changed. At the beginning of July of 2024, their total deficit was about $172,000, and that's before accounting for losses. Then, during the quarter of September, they lost a little over $1,000. By the end of September, their total deficit was about $173,000. Then they had another net loss during the quarter of December of $33,000, bringing them to a total of $207,000. Now we're looking at the statement of cash flows, which shows how cash moved in and out of the company. Their net loss was, as we know by now, $35,000 for the 6 months. There was a decrease in prepaid items of $25,000, meaning they used up some expenses they had paid in advance. There was also an increase in accounts payable of just $400. Overall, they used about $9,700 in operating activities because they weren't making any money. They didn't have any investing activities at all. And finally, they had no financing activities either. This all resulted in a decrease in cash of almost $10,000. They started the period with $34,000 and ended with $25,000. They paid zero in interest and zero in taxes. So what does First America Resources actually do? Well, they used to sell batteries, but now they're planning to get into real estate, specifically buying commercial properties and maybe acquiring a scrap metal company. They want to buy a facility in Georgia, but their ability to do that depends on securing additional equity financing. These financial statements are prepared using what's called the accrual basis, which means they record revenue when it's earned and expenses when they're incurred, regardless of when cash actually changes hands. The company operates in a single segment, meaning they do not have different business units to report on. They consider anything with a maturity of 3 months or less to be a cash equivalent, but they do not have any. They use the fair value method for stocks issued for services. Since they only have common shares, calculating the diluted and basic loss per common share is the same. They follow the standard 5-step model for recognizing revenue, which involves identifying the contract performance obligations, transaction price, allocating the price, and recognizing revenue when the obligation is met. Cost of goods sold includes the purchase cost of the product, shipping, custom fees, and merchant account fees. But since they aren't selling, they don't have costs. Operating expenses are mostly accounting, legal fees, and SEC filing fees. The costs of keeping the lights on at the office, so to speak. They lease their office space from their CEO, but there's no formal lease agreement. They account for income taxes based on the tax effects of transactions, considering both current and deferred taxes. They adopted a new accounting standard for leases, but it didn't have a big impact on their financials. A large chunk of the company's stock is owned by the CEO. That's not unusual. Specifically, over 80% of the company's common shares are owned by the CEO, Mr. Lee, and the transfer dates were in 2013. Here's the kicker. The company says there's substantial doubt about their ability to continue as a going concern. This is a big warning sign that they might not be able to stay in business. They're hoping to acquire a scrap metal company or find another way to make money, but there's no guarantee and they haven't done so yet. They have a net operating loss that they can use to offset future taxes. This might be good if they start making money, but they don't seem likely to do so. Since the end of the quarter, they haven't had any major events that would change the financial statements. Okay, now we're moving into the management's discussion and analysis section. This is where the company explains their results and their plans. The company acknowledges they were previously in the battery business. They intend to acquire FAMSAS, a scrap metal company which is owned by the CEO, and would solve the revenue issue. Let's check how they did with revenue. The numbers speak for themselves. Bank fees and professional fees are the main costs. This section discusses how much cash they have and how easily they can pay their bills. The numbers, as we know, aren't great. The company admits their disclosure controls and procedures aren't effective, meaning they're not confident in their ability to accurately report financial information. This is not something you want to see in a public company. There are no legal proceedings, and the company did not sell any unregistered securities. All right, so what's the bottom line here? First America Resources is in a tough spot. They have almost no assets, they're losing money, and they're heavily dependent on their CEO for loans. They're hoping to turn things around by acquiring a scrap metal company, but there's no guarantee that will happen. They don't have any real revenue, so they are likely just trying to stay afloat and hope for a lucky break. Based on this report, I would say First America Resources is a very risky investment, but I lean on bearish. Their lack of revenue, negative equity, dependence on loans from their CEO, and admission of ineffective financial controls are all major red flags. Unless they get the scrap metal acquisition off the ground and show a significant improvement in their financial performance, I don't see a lot of upside here. Given all these factors, a reasonable price range for this stock would be between practically 0 and 0. I would not invest in this company unless you are okay with the risks. Thanks for watching. If you found this breakdown helpful, please subscribe to Corporate Decoder for more easy to understand analyses of corporate reports.